Hi, ladies and gentlemen. Thank you for watching the latest episode of Global Economic Perspective with Raymond. The global artificial intelligence investment boom has entered a new chapter. Unlike the first wave that was overwhelmingly dominated by Nvidia, today's rally has broadened into a much larger ecosystem about memory chips, cloud infrastructure, foundation models, enterprise software, robotics, and even energy. Recent developments illustrate how capital markets are quickly adapting to this structural transformation. The successful US secondary listing of SK Hynix, one of the world's largest memory chip manufacturers, has become one of the biggest global equity offerings in recent years, attracting overwhelming institutional demand. The transaction was reportedly multiple times oversubscribed, demonstrating that investors continue to regard AI infrastructure as one of the most compelling long-term investment themes despite concerns over high valuations. Much of the capital raised will finance new fabrication plants and advanced packaging facilities to meet surging global demand for high bandwidth memory, a critical component powering Nvidia's latest AI accelerators. Meanwhile, another AI heavyweight, Anthropic, is preparing for its public listing while strengthening its corporate governance with the appointment of former Federal Reserve Chairman Ben Bernanke to oversight their long-term benefit trust. The move sends an important message to institutional investors. Frontier AI companies are no longer merely technology startups. They are becoming systematically important enterprises that require sophisticated governance, macroeconomic expertise, and public market credibility. These developments suggest that AI investing is evolving from speculative interest into a much broader capital market phenomenon. Every major technological revolution creates its own investment cycle. The railway boom in the 19th century reshaped industrial capitalism. The automobile revolution transformed 20th century manufacturing. The internet created the digital economy during the 1990s. Today, artificial intelligence appears to be initiating another structural shift of similar magnitude. And unlike previous technological revolutions, however, AI is simultaneously disrupting virtually every industry. Rather than replacing one product or one service, AI is redefining productivity itself. This explains why virtually every major investment bank now treats AI as a spectacular growth story instead of a clinical technology trend. The current investment cycle is no longer confined to Silicon Valley. Capital is flowing globally, from the United States and Europe to Japan, South Korea, Taiwan, Singapore, and increasingly the Middle East. Sovereign wealth funds, pension funds, family office, and private equity firms are all increasing allocations towards AI-related assets. The result is a remarkable expansion of AI's influence across public and private markets. Global IPO activity provides further evidence of this transformation. Following the blockbuster listing of SpaceX and SK Hynix, investors are eagerly anticipating future listing by Anthropic, OpenAI, and several other AI infrastructure companies. After several subdued years caused by rising interest rates, the IPO market has effectively reopened, but with a very different leadership profile. Instead of fintech or electric vehicles dominating investor attention, AI has become the centerpiece of global capital formation. One of the biggest misconceptions among retail investors is to regard AI investing as simply buying Nvidia shares. That may have been true in 2023. it is certainly no longer true today. The AI value chain has become increasingly diversified, with different industries benefiting at different stages of development. And broadly speaking, AI-related companies can now be divided into 5 major investment categories. The first category is AI infrastructure, which forms the physical foundation of the entire industry. And these companies manufacture semiconductors, memory chips, networking equipment, and data bank hardware required to train and deploy large language models. Representative companies include Nvidia, AMD, TSMC, SK Hynix, Micron Technology, Broadcom, and ASML. Among them, SK Hynix deserves particular attention. Unlike traditional DRAM memory used in personal computers, high bandwidth memory has become the fuel powering generative AI. Every advanced AI accelerator now requires multiple HBM modules working alongside GPUs. As AI models continue growing larger, demand for HBM is expanding even faster than demand for processors themselves. And this explains why SK Hynix has emerged as one of the largest beneficiaries of the AI infrastructure boom. Investors increasingly recognize that memory manufacturers are no longer merely clinical semiconductor companies. They have become strategic suppliers controlling one of the industry's most valuable bottlenecks. The secondary category consists of foundation model companies, the developers of large language models that power today's generative AI revolution. Representative companies include Anthropic and OpenAI, and these firms do not manufacture hardware. Rather, they create the AI brains capable of reasoning, coding, analyzing documents, generating multimedia content, and increasingly acting as autonomous digital agents. Among them, Anthropic has emerged as perhaps the strongest challenger to OpenAI. Its Claude family of models has gained widespread recognition for enterprise-grade safety, non-context reasoning, and software development capabilities. Strategic backing from Amazon and Google has further strengthened its competitive position, giving it access to enormous cloud computing resources while preserving operational independence. The anticipated public listing of Anthropic carries significance well beyond another high-profile IPO. It reflects a broader shift in capital markets where investors are beginning to assign substantial valuation not only to AI infrastructure but also to intellectual property, proprietary datasets, and algorithmic capabilities. In many respects, foundation model companies resemble the operating system of the AI era, just as Microsoft Windows dominate personal computing and Android transform the smartphone ecosystem. Future AI platforms may become indispensable digital infrastructure across almost every industry. The third category comprises the global cloud providers. Artificial intelligence cannot function without enormous computational capacity. Training frontier AI models requires hundreds of thousands of GPUs, sophisticated networking architecture, and huge data centers consuming gigawatts of electricity. Consequently, cloud platforms has become indispensable beneficiaries of AI adoption. The dominant players include Microsoft, Amazon Web Service, Google Cloud, and increasingly Oracle. Microsoft arguably occupies the strongest strategic position. Through its deep partnership with OpenAI, Azure has evolved from a conventional cloud provider into an integrated AI ecosystem, offering developers, enterprise, and governments access to advanced AI capabilities through subscription-based service. Amazon has responded aggressively by investing billions of dollars in Anthropic while integrating Cloud into AWS, thereby strengthening its competitiveness in enterprise AI. Google, meanwhile, leveraged decades of expertise in artificial intelligence through its Gemini family of models, creating a vertically integrated ecosystem spanning hardware, cloud service, and consumer applications. Unlike semiconductor manufacturers, these cloud providers generate recurring subscription revenues. As enterprises increasingly deploy AI solutions, cloud infrastructure becomes not merely a capital expenditure, but a long-term operating necessity. This recurring revenue model explains why investors increasingly regard cloud companies as relatively defensive AI investments. Perhaps the most exciting segment over the coming decade will be enterprise AI applications. Historically, software companies sold tools that enhanced productivity. The next generation of AI software is expected to perform many tasks autonomously. Representative companies include Palantir Technologies, Salesforce, ServiceNow, Adobe, Databricks, and numerous specialized software providers. Palantir illustrates this transformation particularly well. Originally known for defense intelligence analytics, the company has successfully repositioned itself as a leading provider of enterprise AI operating system. Its artificial intelligence platform enables governments and corporations to integrate proprietary data securely with large language models, facilitating complex decision-making in logistics, healthcare, manufacturing, and financial service. Unlike chip manufacturers, whose revenues remain tied to hardware cycles, enterprise software firms generate predictable, recurring subscription income as AI adoption accelerates. This segment could ultimately produce some of the most stable and profitable business models within the entire AI economy. For long-term investors, enterprise AI software may eventually become the equivalent of software as a service. During the cloud computing boom, a structural compounder capable of delivering sustained earnings growth over many years. The final category remains relatively small today, but could ultimately become the largest. And this is physical AI, the integration of artificial intelligence into machines capable of interacting directly with the physical world. Representative companies include Tesla, Figure AI, Boston Dynamics, and Siemens. For years, AI has largely existed within digital environments, assisting users in writing documents, analyzing data, and generating image. The next frontier involved enabling machines to perceive, reason, and perform physical tasks independently. Tesla's Optimus humanoid robot illustrates this vision. Elon Musk has repeatedly argued that autonomous humanoid robots could eventually outnumber automobiles, fundamentally reshaping labor markets across manufacturing, logistics, healthcare, and domestic service. Industrial automation companies such as ABB and Siemens are also embedding AI into factories, creating production systems capable of self-optimization, predictive maintenance, and autonomous quality control. If generative AI represents the digital revolution, physical AI could represent the industrial revolution of the 21st century. Our next question is, one of the hottest topics in the investment market. Is there an AI bubble? Well, the word bubble is frequently used whenever asset prices rise rapidly. The technology bubble of 2000s was characterized by extraordinary speculation surrounding companies that generate little or no revenue. Investors reward website traffic rather than earnings, and countless internet businesses collapsed once financing conditions tightened. Today's AI leaders present a markedly different picture. Nvidia generates tens of billions of dollars in annual profits. Microsoft, Alphabet, Amazon, and Meta produce enormous free cash flow while investing heavily in AI infrastructure. SK Hynix and TSMC operate highly profitable manufacturing business supported by long-term customer demand. Unlike the dot-com era, many of today's leading AI companies already possess strong balance sheets, dominant market positions, and sustainable earnings. Therefore, describing the entire AI sector as a bubble oversimplifies reality. Nevertheless, certain areas undoubtedly exhibit speculative characteristics. Numerous companies have added AI to their corporate narratives, primarily to attract investor attention. History suggests that whenever capital becomes abundant, greater business inevitably emerge alongside genuine innovators. And this selective speculation should not be mistaken for a universal market bubble. Well, at the end of the day, what matters most should be investment discipline after all. Perhaps the greatest lessons from previous technological revolutions is that investors rarely lose money because they identify the wrong technology. They lose money because they pay the wrong price. During the internet boom, many investors correctly anticipate that e-commerce, online advertising, and cloud computing would reshape the world. Their mistake was assuming that every internet company would become a winner. The AI era will likely produce a similar outcome. Not every AI company will justify its current valuation. Not every startup will become the next Nvidia or Anthropic. Nor will every application of AI generate sustainable competitive advantage. Successful long-term investing, therefore, requires more than enthusiasm for technology. It demands rigorous analysis of business models, competitive modes, earning quality, balance sheet strength, and valuation discipline. The most successful institutional investors are unlikely to chase every headline or every initial public offering. Instead, they will focus on identifying companies capable of converting technological leadership into durable profitability over many years. Well, looking ahead, the AI revolution is still in its early stages. If the past 3 years have been about building the digital infrastructure of artificial intelligence, the next decade will be about integrating AI into every sector of the global economies. The winners will not necessarily be those with the most powerful chips, but those capable of transforming AI into scalable, recurring, and profitable business models. For investors, this means the opportunity remains immense, but so does the need for selectivity. The question is, therefore, no longer whether AI will reshape the world, it almost certainly will. The more important question is which companies will still be leading that transformation 10 years from now, and that will ultimately determine who emerged as the ultimate winners. Thank you for watching Global Economic Perspective with Raymond. I'm Raymond Chan. I'll see you in our next episode. Bye bye.